Hello class, this is Dr. Fenton. In the previous chapter we talked about financial statement fraud. We discussed some schemes that have been used over the years to commit such fraud, and we looked at it in a little bit of depth, but in this chapter we're going to talk about how to detect financial statement fraud. So let's get started. Chapter 4. Now this is a long chapter. It's 50 some odd pages long, a lot of reading, and again in this video I'm going to hit just the highlights. So, please view this video and then go back and read the chapter in detail yourself. Let's get started. Let's go to this page. Now first, let's just discuss what fraud is. Now you can read the definitions, various definitions for fraud. The SEC has its own definition. They talk about employing devices or schemes, untrue statements, material fact, practice of course of business, and it's for fraud, deceit, and so forth. Okay, you can read this one. You can read the one from the PCAOB, sort of a long definition here. The Institute of Internal Auditors has its own definition. Black's Law Dictionary does also. But combining all these, then what we come up with, this is very important, the four major legal elements of fraud would be: first, a false representation or willful omission regarding a material fact. Second, the fraudster knew the representation was false. So there's the willful, knowledge it was false. Number 3, the target of the fraud relied on this misappropriation. So you had someone relying on this misrepresentation. And then 4th, the victim suffered damages or incurred a loss. So when you combine all these definitions, these are the 4 legal elements of fraud. So I do want you to know these, like for test purposes. Let's skip a couple of pages here. Okay, now I have this one highlighted because over the years, financial statement auditors, like CPAs going in to perform an annual, audit on a company, maybe for SEC reporting purposes or something. The auditors always tried to take the position, we're not there to look for fraud. We're there just to express an opinion on whether the financial statements materially represent, the operations and the status of the company, right? We're just expressing an opinion. Are these materially correct? In other words, we're not looking for fraud. Fraud occurred in many years, though, and when the injured parties, like the stockholders or creditors, sued the CPA firms, usually the CPA firm would lose, because a lot of people think, the CPAs are there to certify the statements. They are certified public accountants. So you're there to certify that every penny is correct. And the auditors say, no, we're not there to do that. We're just to look at things in general, express an opinion. Are they materially correct? Okay. And so more and more it's leaning towards, okay, outside auditors, if there's major fraud involved, you better locate it and have it taken care of, or you're going to lose in the courtroom. So there has been a shift in the last 20 years or so for outside auditors to be skeptical, consider possible fraud, and a lot of people still think if it's there, you still better find it. So it's been a shift over the years. So that's what SAS 99, Sarbanes-Oxley got into that also. So again, like this sentence here says, external auditors have a poor record of uncovering fraud. In fact, no major fraud has ever been discovered by auditors. Think about that. These CPA firms coming in to audit the clients every year for the purpose of expressing an opinion on the financial statements, no major fraud has ever been uncovered by that outside CPA firm. It's a whistleblower, internal auditor, someone else, but not the outside auditors. So we as CPAs, auditors, we have a very poor track record. I have all this highlighted. I'll let you read this yourself. These are examples of responses to fraud risk. I'll just read number 1 here. Performing procedures at locations on a surprise, unannounced basis. For example, observing inventory on unexpected dates or at unexpected locations. So the PCAOB is trying to tell us auditors, change things up. The client knows you come back year after year. They know what you're going to look at usually, where you're going to go look at it. Change things up, right? And maybe you'll find fraud. Okay, read the others yourself. And this one down here, this is what I was talking about earlier, the expectation gap. This is a lawsuit. United Companies and Deloitte & Touche. Okay, a lawsuit, 2 attorneys involved. The plaintiff's attorney said to the jury, the role of the auditor is to act like a watchdog for the company. A good watchdog barks when somebody comes into the yard. Deloitte & Touche is supposed to bark when there is a problem. So that's a plaintiff's attorney. So it's out there. I mean, they expect us to find that fraud. Now, the defendant's attorney, Deloitte & Touche's attorney, said the problem was much larger than a watchdog could handle. Can a watchdog stop your house from being hit by a hurricane? Of course not. I'm not sure who won the lawsuit here, but the general public still expects the CPAs, the certified public accountants, coming into audit to find fraud if it exists. They expect them to. And let's see, I just want you to, again, be aware of all this information that's out there. In 2000, the Panel Audit Effectiveness Report and Recommendations came out. Of interest, this is for the auditing area, of interest to forensic accountants is the recommendation that auditors should perform some forensic type procedures on every audit to enhance the prospects of detecting material financial statement fraud. So this recommendation says, okay, auditors, financial statement auditors, doing the annual audits, you need to consider having some forensic type procedures. We're not turning this into a forensic audit. That's an even more detailed audit. But have some of these newer forensic type procedures to hopefully look for fraud and find fraud if it exists. SAS 99 plays into this also, down here at the bottom. An increased emphasis on professional skepticism. So as an outside auditor coming in, you're supposed to be more skeptic of the numbers presented to you. You need to dig deeper, possibly. You need to think about things in a different way. You need to have discussions with management. Have unpredictable audit tests. We just talked about that. You need to respond to management overriding controls. You don't want to see management overriding controls. If you see it, you dig further. And then brainstorming. Before auditors go out on the audit team is supposed to get together and brainstorm and think, okay, for this company we're getting ready to audit, where could fraud possibly happen? Who could be doing it? How could it be done? And let's look at that a little bit further. Okay, so you're brainstorming, you're thinking about possible fraud involved, and then you might design your audit test to check those areas. Okay, next page. Let's go a little bit further. And this is page 9, so I want to jump to, this is down at the bottom. Okay. Now, internal auditors, within the larger companies. So, internal auditors are potential auditing combatants of fraud and abuse, but the internal auditing profession suggests that internal auditors are not responsible for finding fraud on the job. So think about that. The internal auditors, as a profession themselves, they're saying, we're not responsible. So the CPA profession, the independent CPAs from the CPA firms come in and say, we're not responsible for finding fraud. We're just responsible for expressing an opinion if the statements are presented fairly on a material basis. Within the company, the internal auditors are saying, well, we're not responsible either. I find this kind of hard to believe, but that's what they're saying. And so I thought this was very unusual. So you read through this a little bit further yourself. And let's see, page 11. Let's see, what's something on page 10? I missed page 10. Oh, I guess I took it off. I don't know. Okay. And here we go. But the IIA has a practice guide, and it says a fraud investigation, the results. So if there is fraud and they do a fraud investigation, then you first notify management or the board when the instance of fraud, significant fraud, has been established to a reasonable certainty. We think we have found it. We need to inform you. And you can read the others. If the results of a fraud investigation indicate that previously undiscovered fraud materially adversely affected previous financial statements for 1 or more years, the internal auditor should inform appropriate management. So this tells the internal auditors, here's what you do if you think you found fraud and then you do a fraud examination and the result. Here's what you're supposed to do. Okay, let's go a little bit further. Now the Audit Committee. Okay, again, you probably had this in auditing. I don't know if I really need to cover this. Again, based on Sarbanes-Oxley, we need to have an Audit Committee, which is a subcommittee of the Board of Directors. The let's see, the requirements: each member of the issuer must be, of the Audit Committee, independent, responsible for appointment, compensation, retention, oversight of the registered public accountant, the CPA firm coming in. And then you can read the others. Hopefully you've already read this yourself in your auditing class. And the Board of Directors role, you can read through this. Sarbanes-Oxley and the SEC have put more responsibility on the Board of Directors to be responsible for fraud, right? You have the Audit Committee. They're supposed to report to you, so forth. You're more responsible for making sure fraud doesn't occur. That's page 14. So let's go to 16. Here we go. And let's go to here. Let's see, nothing there. I highlighted some more things. Go another page here. And again, you need to read these in detail. It talks about, again, internal controls and so forth, control environment, risk assessment, very important. The PCAOB also provides 5 principles for establishing a proper environment. So do you have a good environment for internal controls, and are the internal controls being followed? So again, principle 1, I'll just look at the first couple here. You have a fraud risk management program, and it should be in place. Written policy and so forth. Number 2, fraud risk exposure should be assessed periodically. And then you can read 3, 4, and 5 yourself, techniques, prevention, detection, and a reporting process. All right, and the new approach up until now, based on Sarbanes-Oxley, what Sarbanes-Oxley is trying to do is make everyone responsible for fighting fraud, from the Board of Directors on down. The employees themselves should be on notice to know what to do if they suspect fraud. How do they report it? Who do they report it to? Can they report it and not have to give their name and so forth? Some kind of anonymous tip or whatever. Also, for outside audits, where the forensic accountant finds that there's fraud is probably present, the audit may change to a forensic or fraud examination. So if you had a regular financial statement audit going on, and then you start running into possible or actual fraud, that could change the scope of that investigation. Or you might have a separate investigation going on for the fraud while the annual audit procedures are happening. So this brings into play that the forensic accountant should be an important member of the financial audit team. Let's put it that way. Okay. Now the panel audit effectiveness. And again, some of these groups. Again, we saw this earlier. You try to change things up. Okay. Let's go back and recount the inventory we just counted maybe last week. Unannounced visits to special locations. Let's interview more people or different people. Let's request written confirmations from clients regarding matters that relate to this. Test of accountants not normally performed annually. Again, changing things up, trying to catch your client off guard who may be trying to hide something, to hopefully find fraud if it exists. Because if you don't find it as an outside auditor, the plaintiff might win when they sue you, and you could be out hundreds of millions of dollars if the case is that big. So let's see what we have here. Again, we talked about brainstorming, and so this is required. External auditors are required to do this, and so they have to blend consideration of fraud seamlessly into the audit process and continually update it until the audit is complete. Let's take a look at the next one. Formas. Now 27. Yes. Going back again to cash flows. I talked about this before. If net income is moving in a different direction than cash flow, that is something that needs to be, let's say, looked at closer. Any one thing you might find doesn't prove anything. If you find, well, revenues are going up, cash flow is going down, that doesn't prove there's fraud. But that should show you we need to look at that area closer. Let's redesign some audit tests to try to determine why is this happening. Okay. Again, maybe fraud is present, maybe it's not. But again, if you see things that don't quite look right, you need to explore further. Yeah, so various pages here. Read through this. Great information in through here on what you need to look for to detect fraud. So let's jump to page 31. Whoops, I went too far. Let's go back. Nothing on that page. Okay. So let's go to, I want to jump all the way to page, because this is getting to be a long video, I know. Let's go to page 42. Oh, something happened here. I thought I just selected a page. 32. 4.42. There we go, worked that time. Okay, now, you can get into these items that look simple at first, but then maybe they might help you find an area that needs to be explored further, that then would lead you into hopefully finding fraud if it's present. So some analytical analysis. I know you know what horizontal analysis is, so I'm not going to go in detail, but that turns numbers into percents, right? So you have that base year, and the years after that, you see how much they've improved, or increased or decreased, to see if things look not quite right. You can get into vertical analysis, like if you're doing a vertical analysis income statement, your top line sales or your net revenues are based 100%, everything's based off of that, and you compare that for several years to see if those numbers look straight. If you're doing it for the balance sheet, like the assets 100%, each individual asset, that's total assets, each individual asset is divided by total assets to get that percent, right? So this might just show something that doesn't look right in a specific account. Again, doesn't show fraud is there, but you might want to explore it further. Ratio analysis, same thing. Do these ratios look, now I want to say correct, but look reasonable, I should say. Whether it's the current ratio, quick ratio, gross margin ratio, do these look? And have you seen these in your accounting finance courses in the past? Now, there are other ratios other researchers have come up with, and you can see that for this source, they had various ratios to look at. This had various items or ratios to look at. But I want to look at this one. There were 5 statistically significant ratios, and these are different kind of ratios on the next page. I'll just go ahead and take a look at these. That this researcher found out, if you perform these ratios on a company, then that will be an indicator that you might have fraud involved. This person calls it manipulators instead of fraudsters, same thing. So what this person found, that if you have something called Days Sales in Receivable Index, again, this is a brand new formula for you, probably a brand new ratio, then based on this person's studies, the index for manipulators were 1.5 to 1. So if you start getting towards 1.5 to 1 on this ratio as the answer, it's more possible fraud could be present. And you can see what the ratio is. And you can have these ratios, these new ratios available for your exam purposes. You have the current year's receivables and sales divided by, T minus 1, last year's receivables and sales. Gross margin index. You can see that they have last year's, be careful with all the different items down here, but last year's sales minus last year's cost of goods sold divided by last year's sales divided by the same thing for this year's sales. And for their manipulators, it was 1.2. So if you had one that was like 0.9 or just 1, probably not the tendency for fraud. But getting towards 1.2 and higher, more of a tendency. Here's an asset quality index ratio. So this is quite involved. For manipulators, this is 1.25. So if you compute this, and it's like 1.0, 1.1, not a big concern. Getting closer to or above 1.25, then yes, again, doesn't prove fraud exists, but you might want to look at your assets closer and do more audit tests on assets. Sales growth index, maybe manipulators, they had a higher growth index than non-manipulators. And then total accruals to total assets. Accruals can be adjusted, to put it nicely, to help commit fraud if that was the intention. And so this is a way to compare accruals to total assets. So look at that denominator, quite involved. For manipulators, 0.031, non-manipulators, 0.018. And then another researcher on the next page took those ratios, Charles did his own study, and came up with, well, yeah, they seem to maybe work out, because when I found out the ones that actually committed fraud, for those companies, here were the results of those 5 ratios. For the peer group, the one did not commit fraud, here are the results of the ratios. And you can see these were higher for the companies where you had some kind of manipulation going on. So, new ratios for you, they would indicate you need to explore these areas further. That's what those are for. So that's page 47. Let me look. a checklist. I want you to just look through these checklists yourself. SAS 99 has a checklist. How to try to identify incentives and pressures, opportunities, attitude rationalization checklist. So a good financial statement audit checklist. More checklists here. And so that's about it in this chapter. Let's look at one more thing. Oh, callback provision. Some companies would have this where they say, okay, upper level management, maybe CFO or CEO or whatever, your compensation is based on the results of operations, maybe net income or whatever. Well, if later on those, net income or whatever the base is found out to not be accurate and the statement has to be restated, this clawback provision says, okay, upper level management, you were paid based on those results in previous years. Those results were not accurate. Pay us back. Pay us that compensation back that was based on those incorrect numbers, to put it nicely. Okay. So again, a very long chapter, sort of a long video, I guess. Go back and read it. There's a lot of good information in this chapter. So, as always, good luck with your studies.